Your compliance question.
I am the CFO of a mortgage REIT, a residential mortgage lender, and a mortgage servicer. Our board met to discuss what could happen to our mortgage originations in the event of a global recession. Our secondary and capital markets department is already gearing up for a recession. Our loan originations were affected by rising rates, and not in a good way. Our margins have been compressed, and hedging is difficult. Your name came up in the meeting as one of the board members knows you. The thought was that you have many clients and probably have a good idea about the overall condition of the mortgage banking industry and how it can prepare for a recession. Because of your place in compliance and risk management, she feels that you could shed light on how we can prepare for a recession. Thank you for considering our question. How can a mortgage lender protect itself in a global recession?
Our compliance solution. AI policy program for mortgage banking. Our AI policy program aligns with Freddie Mac's AI governance requirements for Freddie Mac sellers and servicers. Responsible AI practices can help align AI system design, development, and use with applicable legal and regulatory guidelines. Our AI policy program consists of the following policies. 1. Artificial Intelligence Governance Policy. 2. Artificial Intelligence Use Policy. 3. Artificial Intelligence Workplace Policy. 4. Artificial Intelligence Credit Underwriting Policy. 5. Artificial Intelligence Do and Do Not Policy. 6. Artificial Intelligence Ethics Policy. And 7. Artificial Intelligence Vendor Management Policy. Contact us for the presentation and pricing. Response to your question.
Our clients often discuss how their compliance failures result in direct financial losses. During a period of financial stress, a lender scrambling to address compliance deficiencies while also managing credit losses and liquidity pressures faces a compounded crisis that can accelerate failure. In this article, I want to address your specific question about what happens in mortgage banking in a global recession and how to prepare for it. Compliance amplifies everything. Let me state at the outset that compliance during a recession amplifies everything. Specifically, in a recession, the compliance stability connection intensifies because regulators increase examination frequency and scrutiny, GSEs will conduct more aggressive post-purchase file reviews, borrower complaints rise sharply, triggering CFPB investigations, desperate borrowers and originators increase fraud risk, making compliance controls more critical. Investors have less tolerance for defects and push repurchases more aggressively, and state attorneys general become more active in mortgage enforcement. A lender entering a recession with a strong compliance foundation is dramatically better positioned than one carrying hidden violations that regulators and investors are about to discover. Fundamental rule. Here's the fundamental rule to planning for a recession. Lenders who prepare during good times survive recessions. Lenders who assume good times last forever do not. The 2008 crisis wiped out hundreds of mortgage companies that were profitable just 18 months earlier. The ones that survived and thrived afterward had built conservative balance sheets, diversified channels, and operational flexibility long before the storm arrived. Let's zoom out to the implications of a worldwide recession on mortgage banking. Understanding its impact on the banking ecosystem will give us a perspective on how a lender can protect itself in a recession. Mortgage banking ecosystem. In my view, a looming recession triggers a domino effect in the mortgage banking ecosystem. First, there is a significant change to interest rate dynamics. Central banks usually slash interest rates aggressively to stimulate the economy. This creates a refinancing boom initially. As rates drop, homeowners rush to refinance. However, this is short-lived if the recession deepens, since falling rates signal economic distress and lenders tighten standards regardless. Second, credit tightens. Lenders become far more conservative, raising minimum credit score requirements, demanding larger down payments, often 20% plus, reducing loan-to-value ratios, and pulling back on non-QM products like stated income or jumbo loans. Approval rates drop even as applications rise. Third, defaults and delinquency surge. As unemployment rises, borrowers struggle to make payments. This triggers a cascade. Delinquencies rise, yet servicers must advance payments to investors anyway, so servicer liquidity becomes strained and foreclosure pipelines swell. The 2008 crisis showed how quickly this can spiral out of control. Fourth, home prices depreciate. Falling home values are particularly dangerous because they erode equity. Borrowers go underwater, that is, they owe more than the home is worth, which removes the incentive to keep paying and makes refinancing impossible, a classic trap that amplifies defaults. Fifth, secondary markets seize up. The mortgage-backed securities market can freeze. Private label MBS investors flee to safety, leaving originators unable to sell loans or make new ones. Government-backed entities, Fannie Mae, Freddie Mac, and Ginnie Mae, typically become the only functioning secondary market, as happened in 2008 to 2010. Sixth, mortgage servicers become stressed. Servicers face a liquidity crisis. They must keep remitting principal and interest to MBS investors, even when borrowers aren't paying. In a severe recession, servicers may need government bailouts or credit facilities to survive. In fact, the Fed created special facilities for this in 2020. 7. The mortgage industry consolidates. Smaller independent mortgage banks and non-bank lenders fail or get absorbed by larger institutions. Banks with deposit bases survive better. The industry typically emerges significantly more concentrated. 8. The government intervenes. Governments almost always step in with foreclosure moratoriums, forbearance programs, loan modification initiatives, like HAMP in 2009, and direct support for Fannie and Freddie. The political pressure to prevent mass foreclosures is enormous. Ninth, the origination volume paradox emerges. Volume follows a peculiar pattern: an initial spike from refinancing, then a sharp collapse as purchase demand falls. People don't buy homes in recessions. Credit tightens, and eventually even refinance demand dries up as rates bottom out or lenders stop lending. Preparing for a global recession. Preparation before and during a recession requires action across several mortgage banking, originating, and servicing structures. I will discuss them. If any of these outlines resonate with you, please research them further and implement solutions. Credit risk management. Tighten underwriting standards early. The biggest mistake lenders make is waiting too long. Proactive moves include raising minimum FICO score thresholds, reducing maximum debt-to-income ratios, requiring larger down payments, and eliminating high-risk products such as interest-only, stated income, and high LTV loans before defaults materialize. Stress test the portfolio. Model what happens to your book if home prices fall 15%, 25%, or 35% in different markets. Identify geographic concentrations. If you're heavily exposed to a single metro or industry sector, for instance, oil towns and tourist markets, that's a vulnerability to address now. Scrutinize appraisals more aggressively. Inflated appraisals are a recession time bomb, require independent reviews and quality control audits on higher value loans, flag markets showing signs of price softness, and consider conservative LTV haircuts in volatile markets. Avoid layered risk. A borrower with a borderline credit score, a high DTI, a small down payment, and a non-primary residence is extremely dangerous. Build policy guardrails that prevent multiple risk factors from stacking. Liquidity and capital protection. Build cash reserves now. Servicers especially need liquidity buffers because they must advance payments to investors even when borrowers go delinquent. The 2020 COVID crisis caught many servicers dangerously thin on liquidity. Maintain access to warehouse lines well above current need. Diversify funding sources. Over-reliance on a single warehouse lender or investor is a single point of failure. Maintain relationships with multiple warehouse banks, correspondent investors, and the GSEs so that if one channel freezes, others remain open. Hedge interest rate and pipeline risk. Use mandatory delivery commitments, best efforts hedging, or MBS forward trades to protect the pipeline. In volatile markets, unhedged pipelines can incur devastating mark-to-market losses in a matter of days. Reduce servicing portfolio risk selectively. Mortgage servicing rights are complex assets that gain value when rates rise, but generate crushing advance obligations when defaults spike. Consider selling MSR exposure or hedging it before the recession hits. Operational discipline. Right-size staffing with variable cost models. Mortgage volume is notoriously cyclical. Lenders who hire permanent staff during booms are forced into painful layoffs during busts, destroying morale and institutional knowledge. Build a model that relies more on contract processors, outsourced fulfillment, and scalable technology so the cost base can flex with volume. Invest in loss mitigation infrastructure. When defaults rise, your loss mitigation team becomes your most important department. Build it before you need it. Train negotiators, forbearance processing systems, modification workflows, and foreclosure counsel relationships all take time to establish. Streamline default servicing. Have forbearance and loan modification playbooks ready. Regulators and investors will expect a rapid response to borrower distress. Lenders who fumble early outreach face both higher losses and regulatory scrutiny. Portfolio and product strategy. Shift toward government-backed lending. FHA, VA, and USDA loans are backed by federal agencies and have guaranteed secondary market outlets even when private markets freeze. Increasing your government loan mix reduces the risk of being unable to sell loans. Prioritize purchase over refinance. Refinance volume will collapse in a sustained recession. Lenders with strong purchase market relationships with real estate agents, builders, and financial planners have more durable volume than those dependent on rate-driven refinance booms. Reduce jumbo and non-QM exposure. These products rely on private capital markets that seize up in recessions. The GSE's loan limits define the safe harbor. Staying within conforming loan limits maintains secondary market access. Geographic and sector diversification. Avoid dangerous concentration in recession-vulnerable markets, such as tourist-dependent cities, single-employer towns, or areas with overbuilt housing supply. Counterparty and relationship risk. Audit correspondent and broker networks. Third-party origination channels introduce fraud and quality risk. Recession pressure causes some originators to cut corners. Tighten due diligence, audit files more frequently, and be willing to suspend partners whose quality drops. Monitor repurchase exposure. Investors will aggressively push back defective loans during a recession. Review your representations and warranties exposure, shore up underwriting documentation, and set aside reserves for repurchase demands. Strategic positioning. Maintain regulatory good standing. Lenders under regulatory scrutiny lose business flexibility exactly when they need it most. A clean compliance record and strong regulator relationships give you more room to maneuver, including access to emergency facilities the Fed or FHFA might create. Scenario plan at the executive level. Have a written recession playbook. At what delinquency rate do you stop certain products? At what capital level do you halt dividends? What lines of business do you exit first? Making these decisions calmly in advance is far better than making them reactively under pressure. Build counter-cyclical revenue streams. Default servicing, REO management, loan modifications, and distressed asset acquisition can actually generate revenue in downturns. Lenders with these capabilities turn a crisis into a competitive opportunity.
This article, How to Prepare for a Global Recession, published on April 15, 2026, is authored by Jonathan Fox, Ph.D., MBA, the chairman and managing director of Lenders Compliance Group, founded in 2006, the first and only full-service mortgage risk management firm in the United States, specializing exclusively in residential mortgage compliance.